And I'm going to try to explain what's happened in the economy in the last year, or 2 years. So first, money basics. The creation of money. Most money, not all money, but most money is created when we take out loans, when we take out mortgages. We go to the bank, we promise to pay, money is created in a promise from the bank in exchange for the mortgage paper or the loan paper. So the more loans that are taken out, the larger the money supply gets. Homes, cars, boats, anything that we take loans out for, businesses and industry, when they take loans out, that increases the money supply. When government borrows, so to speak, that increases the money supply. Another thing that acts kind of like the creation of money is the speed at which someone spends the money. So a lot of times people will talk about the local economy, and if $1 comes into the economy, it actually does $5 worth of business because it goes from the bowling alley to the gas station to the restaurant before it leaves the community. So the speed at which the money is spent, if people have positive expectations for the future, they think they're going to keep their jobs and they're going to have good business, they're more likely to spend the money quickly rather than holding on to it. And also, if they have expectations of future inflation, they're likely to buy things now rather than waiting for later. So for example, if you knew for sure that the price of gasoline at the store was going to go up tomorrow, you would be more likely to buy gasoline than if you expected it to go down tomorrow. So this is how money is created in our global system, through the issuance of loans and through the more quickly we spend things. What's happened over the last couple of years is that we've seen the destruction of money. When a foreclosure occurs, the bank has to write down the amount of money on their books. So now the mortgage paper isn't worth $100,000 anymore, maybe it's only worth $50,000 when the house is sold. So the bank has to write down the amount of money, and that money is no longer available. It's destroyed, it's eliminated. You and I and everybody in the country are probably in the process of deleveraging right now, which means we're trying to pay off as many of our loans as we can comfortably, or even uncomfortably. And as we pay off loans, that's also shrinking the money supply. We're destroying the money supply. We're destroying money. And the third thing that happens in the process of money destruction, it's not exactly destruction of money, but it's similar, is delaying spending. So instead of going buying the gasoline today, if you really need that money in your pocket, you wait until the tank is on E, and then you spend it then. So delayed spending has almost the same impact of less money in the economy. If people have negative economic expectations, if they think there's going to be a recession that's going to continue for 2 years, they're less likely to buy things, less likely to spend money. Also, if they expect prices to go down on something like automobiles, then they're likely to delay their purchases. So these are some basics about our money system right now. Most money, obviously not bills, those are printed, but most money in the bank, electronic money, is created through the making of loans, and money is destroyed when the loans are paid down. This is called, you could call this the private interest penalty model for the economy, or you could call it the debt growth model for the economy. So now let's look at what's actually happened a little bit more in the past year or so. So here's how the average American spends their money. They spend about $2,000 per year on gasoline and motor oil. And of course they spend money on a lot of other things. But if this slice increases, if the price of gasoline goes from $2 to $4 a gallon, and if they're unable to decrease their use of that gasoline, now suddenly this slice becomes a lot larger. They only have a limited amount of income, so what other slices get impacted by that? And most of this money, of course, for gasoline and oil, that money does not stay in the U.S. because 2/3 of our oil is imported. So two-thirds of the money we spend for gasoline goes out of the country, and it doesn't help our economy. From the Wall Street Journal, when the gasoline price did hit $4 a barrel, $4 a gallon, soaring fuel prices and disappointing unemployment data have reignited fears that the nation's economy will slip into recession. This was a year ago. Slip into recession or pull back further. The recession had already started by last summer. Pull back further if a recession is already underway. And spending on fuel as a share of wage income has shot above 6%. So 6% of the money we made, we were spending on fuel. Approaching 7 to 8% seen during the 80s price surge. So we can see that this would definitely have an impact on people's spending, their expectations for the future, and the economy as a whole. So again, I'll revisit this chart. When the oil prices went up in the past, up to 7%, 6% of GDP, that caused a major recession. It's probably not surprising that when the prices went up again, that we had a recession as a result. So the 2005-2008 gas price increase from $2 to $4. Buyers tended to delay purchases because they didn't feel as rich because they were spending more money for gas all the time. They spent less on homes, RVs, cars, appliances, vacations, and other big ticket items. For the business person, the sellers, you could say, that led to, fewer sales, which in many cases led to businesses being overstocked with bills yet to pay, expecting more income. You could think of this as GM or any company that's had a lot of difficulty in the last few years. Forced to lower prices in order to make some kind of income for the business, ending up suffering losses, a lot of times having to lay off people, closing shops. This leads to less people being employed, which leads to less tax revenue for the whatever tax unit it is. And that, of course, leads to less public or government employees. So this is kind of what has happened. This is another way of looking at what has happened over the past few years. People bought less, impacted businesses, and this is kind of the sequence of what the business goes through. One more look at how gasoline prices impacted everything. This again is all the spending that you would do in a year: food, transportation, recreation, housing. And the gasoline part of the circle was getting larger. More people were spending more money on gasoline. That was squeezing other things out. So people were spending more money on gasoline. Their actual behavior was to buy less cars and trucks. Okay, maybe the transportation amount of money people spent on transportation was the same, but as they were spending $4 a gallon on gasoline, less new trucks, cars and trucks were being purchased. So this is a major problem with our economic system right now, as if gas prices go very high, it squeezes out all these other businesses. All right, so back to the money basics. These are the basic things that aren't taught in high school, and a lot of times they're not taught in college. But money creation is in the making of loans. As long as loans are being made, money supply increases. As long as there's positive expectations for the future, or rising prices, or a combination, people buy quickly. This is good for the economy, so to speak, because it grows the money supply. The money supply right now is shrinking. The Federal Reserve is doing what it can to increase the money supply, and it can do quite a few things, but we are paying off our loans so quickly, and there are so many write-downs that the money supply is quickly shrinking. People have negative expectations for the future, and so that's impacting our economy.